Hi, this is Beau, host of the Investor Financing Podcast. I appreciate you checking out our channel. On this podcast, we talk about real estate, investing, financing, business lending, and acquiring and expanding your business. I'm sure you will find some videos here that will help you build your business empire. There's a lot to see. Take your time and make sure you comment, like, and subscribe. Thanks again. Going back to agency prepayment penalties, yield maintenance. Can you talk on the subject of a step down versus yield maintenance? You're going to get a better rate with yield maintenance, right? Essentially versus the step down. But how does yield maintenance throws a lot of people off, because it's like, how do I even calculate what that penalty is going to be?
Yeah, so I get this question all the time. The best way to explain the yield maintenance calculation is to assume that if you do a 10-year fixed, that you are responsible for the interest on that loan for all 10 years. Obviously, there are some metrics that change as the 10-year note goes up. The prepayment is a little bit less, but I had a borrower email me yesterday about that. How do I calculate it? And I said, well, you contact servicing, they can get you the exact amount. But just take into account that you're 3 years into the loan, you got 7 years left, that you're responsible for those 7 years of interest.
And so then some people opt in to go the step down because they're thinking that they are going to refinance. Is that why you would usually opt into a step down prepay? You're going to pay a little bit higher interest rate, but if you're going to sell or refi year 3 or 4, you're not going to get caught up in.
Yeah, I always try to push people towards the step down because then they know exactly what their prepay is. I have borrowers that say, Matt, I don't care. I'm not selling the property. I want the yield maintenance. I'm not going to refinance the property. 10 years go by at a snap of my finger. But then I have borrowers that tell me, hey, I'm not selling the property. And then 2 years later, they say, hey, I've got, an offer on the property that's $2 million over what I paid for it. What's my prepayment? Well, your prepayment's $700,000. So, I guess the way that I look at it is, yeah, you do get, a discount for taking the yield maintenance. But if you want to refinance and pull cash out and move on to another property or sell your property, on a 10-year fixed, if you're 4 years into it, you know that you're 5.54433. So you're 3%. And you can calculate that right off of whatever your unpaid principal balance is. So you know exactly what your prepay is. Whereas, it's a guessing game on the yield maintenance.
So the options for terms is a 5-year, 7 and a 10-year amortization over 30. But we also have like and can you kind of dive into the Freddy Floater program? I don't know if
sure. So yeah, it's called the hybrid program, and it's basically 5 years fixed. It's a 20-year note on a 30-year amortization. So if you do a 5-year, you're floating for 15. If you do 7, you're floating for 13. 10, you're floating for 10, and then the note comes due in year 20. So it adjusts at 1% per year. Your floor is going to be your start rate, and the max over the life of the loan is typically it's like 11.5%, call it.
But the prepay is more liberal on that one, or something. Is that I'm trying to cue why an investor would go with it, because I knew like a year ago it seemed like it was a hot product, but why would an investor want to go into a Freddy Floater?
So a couple reasons. One is they don't like the idea of a balloon at the end of the note. So this gives them the ability to float and see what the market is. So if the market has gone down, then they can refinance, and that 1% during the floating period is waived. If it's gone up, but their rate is roughly close to what their note rate was, then they can just sit there and let it float until rates get too high, and then they can lock in something else. So that's the main reason why they do that is, they don't want to have to refinance. They don't want to be forced to refinance at the end of the fixed period. And it gives them a little bit more latitude.